What if I told you that the biggest threat to the global economy isn't inflation, unemployment, or even war, but debt? Not the kind of debt that keeps you from buying a car, but a shadow so large it wraps around the entire planet. Over $315 trillion worth. That's nearly 3 times the size of the global economy itself. But here's the real mystery. Who actually owns this debt, and who will pay it back? Because in this story, every country, every corporation, every citizen is both a debtor and a creditor. And when everyone owes everyone, what happens when the bill finally comes due? To understand today's crisis, we have to go back, not to 2008, not even to the Great Depression, but to the moment money stopped being real. In 1971, US President Richard Nixon made a fateful decision. He ended the gold standard, cutting the final link between the US dollar and gold. Until then, global currencies had to be backed by physical gold reserves. It kept spending and borrowing it in check. But once the dollar was set free, governments around the world discovered a dangerous new tool. They could print money at will. It was the birth of the debt-based economy. Money became a promise, backed not by gold, but by trust, and trust could be borrowed. Banks realized they could lend out money that didn't even exist yet. Governments realized they could fund wars, infrastructure, and welfare without raising taxes, just by issuing bonds. Debt became the lifeblood of growth, and like any addiction, it started small, then grew uncontrollably. Fast forward to the 1980s and 1990s. Debt was no longer a last resort, it was a strategy. The US used deficit spending to power consumer demand. Japan fueled its economic miracle with easy credit, and developing nations borrowed billions from the IMF and World Bank to modernize their economies. For a while, it worked. Debt-funded growth looked unstoppable, but behind the scenes, a dangerous imbalance was forming. Wealthy nations lent, poorer nations borrowed. Banks created exotic instruments, derivatives, swaps, and securities to multiply their profits. And as long as the system kept expanding, no one cared how fragile it really was. The world's financial markets became a house of cards built on borrowed bricks. Then came 2008. When the housing bubble burst, the illusion shattered. Banks collapsed. Credit froze. Trillions of dollars vanished overnight. Governments rushed to rescue their economies by taking on even more debt. The US Federal Reserve slashed interest rates to near zero. Central banks around the world followed. Cheap money flooded the system again. And instead of curing the disease, it fed it. From 2008 onward, global debt didn't shrink. It tripled. Corporations borrowed to buy back their own stock. Governments borrowed to stimulate their economies. Households borrowed to survive stagnant wages. We were told this was recovery, but in truth, it was a reset built on the same addiction. The world had entered the age of permanent debt dependency. By 2020, the cracks began to show again. COVID-19 hit, and the response was the largest money-printing experiment in human history. In just 2 years, central banks created over $30 trillion in new money. It saved the economy, temporarily. But it also unleashed the monster we now face: record inflation, collapsing currencies, and unsustainable national debt. Today, the US alone owes more than $35 trillion. Japan's debt-to-GDP ratio is over 260%. And emerging markets from Argentina to Sri Lanka are defaulting under the weight of impossible interest payments. Even Europe, once a model of fiscal restraint, now owes more collectively than ever before in history. It's as if every country is trapped on a treadmill that speeds up each time they try to slow down. Because here's the cruel irony: to pay off old debt, we must issue new debt, and that means the system can never truly be free. Over the decades, every proposed solution has only deepened the trap. Raise interest rates, and you risk triggering a recession. Lower them, and you fuel inflation. Cut spending, and growth collapses. Print more, and the currency weakens. There's no easy exit, because debt is now the engine itself. Global finance runs on IOUs. Pension funds, stock markets, and entire banking systems depend on the assumption that governments will always pay, even if that means printing more money. And the deeper question becomes, who actually holds the keys to recovery? Is it the central banks who control the supply of money? The creditors, like China, which holds over $1 trillion in US debt? Or the citizens, whose taxes and savings ultimately foot the bill? The uncomfortable truth is that no one is in full control anymore. The system has become so interlinked, so leveraged, that pulling one thread could unravel the whole web. If all this sounds familiar, it's because it is. History doesn't repeat exactly, but it rhymes. In ancient Rome, emperors debased their silver coins to fund wars until the currency collapsed. In the 18th century France, the monarchy printed assignats, paper money backed by confiscated land, and triggered hyperinflation before the revolution. And in the 1920s, Weimar Germany printed marks until bread cost billions. Every time, leaders thought they could manage the crisis. Every time, debt destroyed trust, and trust destroyed the system. And yet, here we are again. Today, over 60% of the world's nations are in some form of debt distress. Interest payments alone are swallowing public budgets. And the next crisis, whether triggered by a banking collapse, geopolitical shock, or digital panic, could force a reckoning unlike any before. So what can we learn from all this? 1. Debt isn't just numbers on a balance sheet, it's a measure of trust. And once that trust is lost, money itself loses meaning. 2. No nation can borrow its way to prosperity forever. Growth built on debt is temporary. Real wealth is created through productivity, innovation, and balance, not printing presses. 3. Every financial crisis starts as a confidence crisis. When people stop believing the system can sustain itself, that's when collapse truly begins. We stand at a crossroads. If the global economy keeps expanding its debt without reforming its foundation, the next correction could make 2008 look like a rehearsal. But if we face the truth, that sustainability, not stimulus, is the real key, recovery is still possible. So the next time you hear about national debt, don't just think of it as an abstract number. Think of it as the story of how we borrowed from the future, and how someday soon the future will ask to be repaid. Because the question isn't whether the world can recover, it's whether we'll change before we're forced to. If this story helped you see the world's economy in a new light, subscribe for more deep dives into the forces shaping our financial future. Because understanding money is the first step to mastering it. This is Financial Technician. See you in the next one.